So, first question for the head of Sustainable, Responsible, and Impact Investing is, do you own Facebook?
Well, I don't think I'm supposed to talk about individual companies, but I can tell you that there's a lot of big companies that you might see in a typical portfolio that we do not own for ESG reasons.
There are a lot of big companies that you do not own for ESG reasons. Put those words together, folks. You can, as they say, do the math. So what makes a company, more generically, qualify for your ESG portfolios, and what rules them out? What are you looking for, and what are you looking to avoid?
Well, it's a really good question, and obviously it's a somewhat complex answer. I would say this generally, ESG is a process. It's not a panacea. So you have to have a really dedicated, disciplined way of doing this. We do it a couple different ways. We do have our own proprietary way of, scoring ESG. So that's loosely looking at a group of factors, up to 5 to 8 factors, depending on the asset class that we're talking about, where we isolate the things that we think will have a material impact on the company. But we also really are building portfolios for our wealth management clients, for our family clients, for our institutional clients. And we understand their view of the world. So we look at suitability. So, for example, some of these big companies that in a scoring framework, you might say, okay, it's within a range that you might accept, but we might still exclude that company because we don't think it necessarily aligns with our clients' values. So you have to do two things. I think you need to have your own disciplined approach to really understand companies. A lot of things could flow into that. You're familiar with this kind of range of data that flows into these kind of ESG scores. But you also have to have a little bit of a worldview, and you have to understand what your clients really want to see in them, and then put it together to deliver portfolios that can help them balance their financial and their social and environmental goals. So, you're not trying to run at the expense of another.
So, forgive me for interrupting.
Yeah.
So, are you among the many believers who say, not only can I match the market by investing in environmentally responsible companies or governance companies or whatever, impact companies, I can beat the market? And I ask that specifically because I know that one of the things you try and avoid are extraction, or companies that extract fossil fuels. And this year, it would be advantageous from a return standpoint to invest in companies that are in the fossil fuel business. Do you believe that you can deliver superior returns and stick to your principles?
Yeah, we have delivered excellent returns to our clients, factoring in ESG. I entered this field in 1990, so I've been answering that question, for a long, long time. And for most of the time, it was sort of, are you going to lose money if you do this? Let's say traditional socially responsible investing. I think we've had a total capitulation in the market that a lot of these things that you're looking at, let's say climate change, which might be an issue that someone who would want a fossil fuel-free portfolio is interested in, actually can have a material impact on the portfolio long term. So we absolutely believe, and we do deliver competitive returns. If you look at the history of things that might get avoided in a portfolio, whether they're that basket of traditional, the alcohol, tobacco, the guns, controversial weapons, et cetera, they've expanded quite a bit, or things like oil and gas, or maybe big tech. What you'll find is, things are cyclical in the market. So there might be times where it hurts you a little bit not to own something, but that tends to smooth out over time. So you really can dial in the risk and return characteristics of a portfolio almost in any asset class and still express some ESG value in that portfolio.
Yeah.